Hi friends, there are two methods to invest in passively managed funds. Investing in index funds, investing in exchange traded funds, ETFs. Now the question is, which one is better? In this video, I'll try to simplify the differences between index funds and exchange traded funds. This information helps you to pick the best alternative. On index fund topic, I made 4 videos where I explained about its meaning, advantages, disadvantages and about tracking error. Links I am leaving in the description box. Let us know the meaning of exchange traded funds. To define exchange traded fund, let us break down the term into 3 parts. Exchange, trade, fund. Exchange means stock exchange. Trade means buying and selling. And ETF is a fund. AMC pulls the corpus from investors and invests in securities. Therefore, ETF is a passively managed fund which is traded in stock exchanges. Index funds and ETF share some similarities. Both are issued by AMCs. Both are passively managed funds. Both funds track one market index. Both offer the benefit of portfolio diversification. And ETFs can be created with any kind of asset or security which has an index or a liquid market. The various kinds of ETFs currently available in developed countries are index ETFs. They track market index. In India, index ETF tracks Nifty 50, Nifty Next 50, Sensex 30, Nifty 100 and BSE 100. Second one, bond or debt ETF. They invest in bonds or debt instruments such as government bonds, corporate bonds, local bonds like municipal bonds. Next one, sector ETFs. They track the index of a particular sector like banking sector, mining sector, healthcare sector and so on. Next one, commodity ETF. They invest in commodities such as agricultural products, currency, precious metals like gold, silver, platinum, diamonds, palladium, etc. ETF divides total assets it holds into smaller units termed as shares. In India, 3 ETFs are available: index ETFs, bond ETFs and gold ETFs. Index ETFs are popular in our country. Differences between index funds and ETFs. First point is buying and selling. You have to trade index funds just like other mutual funds. If you want to purchase them, you can directly buy from AMC. Similarly, if you want to sell them, you have to directly redeem with AMC. Come to ETFs. For example, one asset management company launched one ETF scheme in the month of January by issuing one NFO, new fund offer. Now you can directly buy them from AMC. Not in January month, you want to purchase them after 6 months. So in July, you cannot buy them from AMC now, but there is one option. ETFs are listed in the stock exchange just like ordinary shares. In July month, if you want to buy, you can purchase them from other investor through a stock exchange. This is just like buying ordinary shares in primary market. In July month, if you want to buy ETFs, you can buy them from other investors through a stock exchange at prevailing market prices. Similarly, if you want to sell them, instead of redeeming with AMC through a stock exchange, you can sell them to other investors. Thus, like an ordinary share, ETFs can be traded in the stock exchange. To trade ETFs through stock exchange, you need to open one trading account with a broker or sub-broker and you have to maintain one demat account to hold your ETF units. Second difference is expense ratio. Many index funds have expense ratios between 0.2% and 1%. The expense ratio of ETFs are comparatively lower than index funds because AMCs can pass on the client service expenses to the brokerage firms. They do not maintain any call centers to answer investors' questions. They do not send any monthly statements, quarterly reports or annual tax reports to the investors. These savings can be passed on to the investors in the form of lower expense ratio. However, as ETFs are traded as ordinary shares, there are several other expenses like annual charges to maintain demat account, brokerage commissions, etc. These expenses may increase the cost in ETF despite of lower expense ratio. Third difference is trading procedure. Let us see the mechanism of NAV when we buy or redeem index fund units. There is typically a cutoff time for placing purchase order or sale order. This cutoff time may vary for different portals. Say for one particular portal, cutoff time is 1:30 p.m. On a particular day, 15 January 2020 at 11 a.m. index say Nifty is at 11,200 points. By 11:30 a.m. say it is fallen by 200 points. At 12 there is a further decrease of 300 points. And at 1 o'clock Nifty is 10,500 points. As the market is going down, one investor wants to purchase index fund units. He is thinking that he will be allotted the units at lower NAV. He placed a purchase order before the cutoff time, say at 1:10 p.m. There is a further decrease in market and the market is closed at 10,000 points by the end of the day, that is at 3 p.m. Now index fund units are allotted to the investor at NAV, which is calculated based on 10,000 points. That NAV will be announced either late night or on the next working day. In this example, investor is able to get the units at lower NAV. Suppose after 1:30 Nifty started rising and it is closed at 11,400 points. Investor placed purchase order at 1:10 p.m. At that time, Nifty is 10,500 points. But units will be allotted on the basis of 11,400, not on the basis of 10,500 points. Here, investor is getting the units at higher NAV. So, index fund units are allotted based on the closing Nifty levels, not on the basis of Nifty levels at the time of placing the order. Investor must wait till the next day of placing the order to know how much he has to pay while purchasing the units and how much he will receive while selling the units. Thus, index funds are traded only once per a day after markets close. Investor cannot make profits through intraday pricing changes. Intraday means throughout the day. If order is placed after 1:30 p.m., that order will be executed at the closing NAV of next working day. Now let us see the procedure of trading in case of ETF. Suppose one index ETF is tracking Nifty 50. You know ETF shares are traded in the stock exchange. The market price of ETF share depends on the changes in Nifty 50 on a particular day, that is on 15/1/2020. For these 50 company shares, if there is a strong investor demand, then Nifty increases, resulting a rise in the market price of ETF share. On the other hand, if there is a weak demand for these 50 company shares, Nifty decreases, resulting a fall in the market price of ETF shares. Here, you have to remember one limitation of ETF. The price movements in ETF do not correctly represent the changes in market index. At a particular point of time, for ETF share, if demand is more, ETF may be traded at a price which is relatively higher than the market index. On the other hand, for ETF share, if demand is less and supply is more, ETF may be traded at a price which is relatively lower than the market index. Index funds are traded only once per day now after markets close, and in case of index funds, investor cannot make intraday price change profits. But in case of ETFs, they are traded throughout the day. You can buy ETF shares in the morning and you can sell by afternoon. Similarly, investor can make intraday price change profits. At any point of time, the price of ETF is visible on the screen and you can transact at that price. You can buy at a lower price, for example at 100 rupees, and you can sell that share at a higher price, for example at 105 rupees, and you can make profit. That profit is known as intraday price change profit. Intraday means throughout the day. As ETFs are traded like ordinary shares, investor can use some advanced trading techniques such as trading on margin, short selling, trading through stop orders, limit orders, speculative strategies, hedging strategies, arbitrage. All these are stock market related terms. So in stock market series, I will explain about them, not in this video. Now come to the main point. Which one is better, index fund or ETF? I will tell some points to you. Keep them in mind while taking the decision. First point is, don't compare the expense ratio of index fund with that of ETF. In case of ETF, add other expenses also, like annual charges to maintain demat account, brokerage commission, and ascertain total expenses. Now compare total expenses of ETF with expense ratio of index fund to take the decision. Second point is, in case of index funds, you need not to maintain any demat account, but to trade ETF shares in the stock exchange, you need a demat account. If you are frequently buying and selling ordinary shares in stock exchange, as already you are maintaining demat account, it is better to go with ETFs. And if you are interested only in mutual funds, you have to opt for index funds because you need not to maintain any demat account here. Third point is, liquidity plays a vital role while investing in ETFs. Investor purchases ETFs from AMC, while investing in ETFs, investor has to observe the volume of ETF. The more volume ETF has, the more frequently it is traded in stock exchange. The more frequently it is traded in stock exchange, the more liquid it is. If investor purchases low volume ETFs, it is very difficult to find a buyer when he wants to sell them through a stock exchange. So always prefer an ETF with high volumes. Fourth point is, compare the tracking error of index fund with that of ETF. You have to pick a fund with a lower tracking error. And while calculating tracking error of ETF, AMC is doing one mistake which you have to keep in mind. AMC is considering the NAV of ETF, which is a wrong method, because investor is not at all concerned with the NAV of ETF. Investor is always concerned with the market price of ETF. So to calculate tracking error, AMC should compare the market price of ETF with market index. No AMC is following this rule. Last point is, in case of both funds, it is always advisable to stay invested for a long period. Then only you can get the benefit of compounding investment. But in case of ETF, you have to be very careful, because there is an option of selling ETF shares through a stock exchange at any time. When market is favorable to you, you may be tempted to sell your ETF shares through a stock exchange. In that case, you cannot enjoy the benefit of compounding investment. I think now you have a brief understanding of the differences between index funds and ETFs. Thank you for watching this video.